Welcome back to Letnick. My name is JP, and in this video we're going to be discussing credit scores and why it's important when you're applying for a mortgage product. Starting off with the basics. Credit scores are calculated and you're given a number of roughly 300 to 900 depending on how you manage your money. If you are just starting off and you have no credit worthiness, then your score is probably going to be around 700 or 800 to start. Depending on how you pay your bills on time or how much money you've borrowed and whether or not you have a credit card and if you use it, these are all aspects that will affect your credit score. The better you manage your money, the higher your credit score will be. One of the important factors of this is also how much of your credit are you using. For example, if you have $1,000 in credit, when you're just starting out, you may have a credit card for $1,000. The more you keep that paid off, the better. If you're using over 50% of the allowable use on that card on a regular basis, and you're holding a balance of, let's say, $500 to $1,000, and you aren't paying it off on a regular basis, then that will affect your credit score negatively. Even though you're making your payments on time, the amount of credit that you're using is also a large factor of determining your credit score. So what you want to do is make sure to only use less than half of the credit balance that you have available, pay it off regularly, and over time you can increase your credit limit. When you increase your credit limit, then you have access to more space on that credit. Of course, if you're using most of that credit limit and then paying off right away on an occasion and not holding a large balance all the time, this will still also help your credit score. Just don't hold a large balance on a regular basis. In Canada, most of the banks are using Equifax as their determination of what your credit score will be. Now, not all banks are going to use Equifax. There are other credit reporting bureaus as well, but Equifax is the most well known. You can even get a free report from your credit score from Equifax sent out to you once per year. Why is it important to keep your credit score high? Well, this is going to affect your interest rates on your loans that you get, whether that's a mortgage or a car loan. Depending on your credit score, it will determine whether or not the banks trust you enough to give you money to begin with. If you have a high credit score, they trust you more and they'll actually give you a lower interest rate. So a higher score means you have more trust in the eyes of the financial institutions. Whether you're getting a car loan, a mortgage, or home equity line of credit, or even just a standard loan from the bank, a higher trust score is essentially what we're going to call it. A trust score is a credit score, and that will give you a better rate. Your credit score is important as it's the level of risk that is present for not only a mortgage broker, a lender, a bank, but also can be used if you're applying to be a tenant. Landlords are often asking for credit reports now to see your trustworthiness on how you manage your money. If there's anything like a judgment or credit owing on your report, then that may indicate to a landlord that they maybe want to go with somebody else who has a better credit score, better at managing their money, because then they'll be less likely to have late rent payments. In Canada, we have two reporting agencies. One is Equifax and the other one is TransUnion. Those are the two major reporting bodies that the banks will be using in order to determine your credit worthiness. They compile a large list of things, including your phone, utility bills, mortgage payments, your credit card history. You put it through a big algorithm and then it pops out a number. One thing to keep in mind is the number that you may see on your Equifax report may differ from TransUnion because they are two different reporting bodies with their own algorithms. This may also be different from a website such as Borrowell, where you can view your credit report on your own, and versus a credit score that is pulled by the bank. They'll all be roughly the same, but there'll be maybe a spread of around 50 to 100 points depending on which report's being used. So as I just mentioned, there's a website called Borrowell. This is not sponsored. I use this personally myself to check my report every once in a while and check my score. They also give some recommendations of different things like credit cards or personal loans that you might want to be able to get based on your current score. You can also order a report from either Equifax or TransUnion. One of them is typically free, but if you want more than that, then normally you'll have to pay. There are also services that they'll offer, such as fraud reporting, to make sure that you know what's happening with your credit score, or if someone is trying to pull credit reporting bureau without your permission. So important things to remember regarding building a strong credit score is keeping a low utilization. So 50% or less of your credit availability. Don't go above that and hold a large balance. It's important to keep that in mind. Over time, you can increase your credit limit and then use a little bit more of that space. Payment history is also one of the most important things. Now, this not only applies to your credit card, it also applies to things like cell phone bills or utility bills. Now, paying those on time is not necessarily going to help build your credit score, but if you miss your payments on your utility bills or your cell phone bills, that will negatively affect your credit score. So remember, payment on time is important. Also, having a variety of credit is going to help you build your credit score. Showing that you can manage more than just one credit card, mortgage payment, or any other vehicle of credit is going to help you build a stronger credit score. To start off, one credit card is totally fine. You want to help build that over time, but then as you grow your credit, you want to be able to show that you can manage your money in different vehicles, such as a mortgage payment with maybe 2 credit cards, and maybe you have utility bills that you pay every single month. So showing all this as a well-rounded manager of money will help increase your credit score. There's a cute little infographic of a popsicle, which we're going to show you right now, but basically it breaks down how your credit score is essentially calculated. So as you can see, payment history is very important. It makes about 35% of the calculation versus 30% is credit utilization. So making sure you don't hold a large balance. 15% is your credit history and how well you managed it. 10% is a credit mix. So again, that's what we talked about. We're having a variety of things like credit cards, mortgage payments, and utility bills. And then 10% is credit inquiries. So this is also a very important note, that if you go credit shopping, for example, and you're going to get a credit card and you apply at, like, let's say 5 to 10 different places for a credit card, all of those credit hits are going to slowly decline your credit score, because that's just what it does. It makes you look like you're maybe desperate for some credit, and then that is negatively affecting you. So when you're going shopping for a mortgage, for example, don't go to every single bank and every single mortgage broker asking for a application, because that's going to start negatively affecting your credit, as each time they check your credit, it will show up on your credit report. Now, your credit report is going to be changing and fluctuating basically on the weekly basis. Every single week, the credit reporting bureaus will get updated on all this information, and your score will fluctuate. A great tool, again, is Borrowell. You'll be able to see your score going up or down or staying roughly the same on a weekly basis. So what is a good credit score? Well, a good credit score is typically ranging anywhere between around 700 to 800. Now, if you have anything over 800 and up to 900, that's an excellent credit score, and you should have no problem qualifying for something based on your credit. Most of the banks are going to look for at least a 650 of your credit score. Anything below that, and that is a little bit too much of a risk factor, and they may want you to increase your credit score before they lend you money. Either that, or they're going to charge you a higher interest rate, which seems counterintuitive that they would charge a higher interest rate for somebody who has issues with money. Now, of course, this is because they want to be compensated for taking on the risk of dealing with someone who hasn't managed their money properly. But it does, I know, in our consumers' view, seem counterintuitive that they're charging the person that needs a little bit more flexibility. But this is why you need to focus on managing money first before you borrow to buy a property, because that way you get your lower interest rate when you buy your large purchase with a large amount of money that's being lent to you. So to summarize, again, check and review your credit report frequently to ensure there are no errors. Make sure that there's no one else trying to access your credit and apply on your behalf for different things. Pay all of your bills on time to avoid penalties and delinquencies, and pay down your revolving debts to reduce credit usage, credit cards, lines of credit. Make more than the minimum payment on your credit cards and bills. Make sure that your balance stays low. Now, let's say you've been managing your credit very well, but something shows up on your credit report that you didn't do. Well, this is important to make sure you contact the credit reporting body, such as Equifax or TransUnion, and let them know that something has shown up that you didn't complete, and you would like them to look into it to make sure it gets resolved or removed from your credit reporting system. It is important to make sure that you also keep an eye on your credit reporting so that if there's any issues of fraud, you can deal with it right away. One of the common misconceptions regarding credit is if you have a high income, you'll have a higher credit score, and this is not true. Your income does not affect your credit. What matters is how you managed the money. So if you have a high income, typically you should be able to manage your debt But that's not always the case, as we often see. People who make a lot more money often spend more money and end up in more debt. So it doesn't matter if you make more money, you just need to be able to manage it properly. Another thing that is important, especially when applying for a mortgage and being careful of, is let's say, for example, you have a credit card and your spouse has a secondary, or vice versa. Your spouse has a credit card and you are secondary. The secondary cardholder, it does not help their credit. It does not hurt their credit, it does not help their credit. So important to note, if your partner has good credit, that does not mean you do. You want to make sure you want to have your own credit card in your own name that you use roughly once per month, at least as a minimum, and pay it off regularly so that you can start building your credit score. This is incredibly important because it happens quite often when we'll get to a mortgage broker's approval process and they'll say, oh, your credit is great, but your spouse has no credit. And they'll be like, but I have a secondary card on their credit card. And then they realize that didn't help you. That doesn't help you at all. So make sure you're not just a secondary card holder on someone else's account. You want to make sure that you have your own credit card and credit products so that you can build up your credit score. Bottom line, there are a lot of different factors that affect your credit, and credit affects a lot of your life. Unfortunately, that's just how it works in our system, where this number is not the end-all be-all, but it is very important to whether or not you get trusted by the financial institutions. So when buying a house, remember it is important to plan ahead of time, check your credit score, and build it up before you apply for a mortgage so that you have the best chance of getting the most and the best rates. If you found this video helpful, please remember to like, subscribe, and put a comment down below about what you'd like to see on the next video. Thank you again for tuning in. My name is JP, and we'll see you next time.